So as Liz pointed out, a stall in the rally in U.S. stocks overnight as they remained at near record highs that was struck earlier in last week really. Markets that just opened on Monday U.S. time. Traders are bracing for a barrage of economic data, namely the PCE, which is the Fed's favorite inflation gauge. It's projected to show the biggest increase in a year, a continuation of the previously hot print. Wall Street is also keeping a close eye on how the market will manage to absorb heavy treasury and corporate sales as market positioning begins. Michelle Schneider is Chief Strategist at Market Gauge, joining me now on Asia First. Good morning, Michelle. Thanks for joining me. Let's take a look at the data this week out both from China and the US, namely the manufacturing print from China and, of course, the PCE in the US. Are you expecting anything significant from these prints? Do you think they'll be as hot as they say?
Well, certainly we can argue that inflation troughed in October when we started to see the rise in the CPI and the PPI. So there's no doubt that the PCE numbers will be better, or I should say better, they'll be worse, depending on what side of the inflation argument you're on.
Yeah.
But in other words, there will be more inflation. I think the real question is, A, will it really surpass what the expectation is for it to be higher? Mm-hmm. And B, is this really now a trend that we saw starting in October that will continue as we get into March and April? And I think that's what the Fed is going to watch out more for. It's not going to be so much this number per se, but it'll be, is it becoming more and more uncontrollable at current interest rates?
Right. And do you think, I'm trying to understand it as simply as I can, Michelle, is this more of a delayed wave that's coming out and then it starts to taper off, or am I seeing this a bit too simplistically?
No, actually, it is really not as complicated as people would like to think. It really comes on, it comes on the heels of two things. Number one is, to date, regardless of the fact that we've had supply chain issues and weather issues, and the fact that food prices as a result have remained elevated, oil is flirting back around that $80 a barrel mark. Despite all of that, nothing has projected to the market a sense of fear yet.
Right.
And it may not happen, in which case, at these rate levels, there's a certain level of normalization that has happened where the rates are controlling the inflation. I mean, there could be slippage up and down month to month, but with nothing dramatic happen, we could actually say mission accomplished. But of course, the cynics out there, myself included, look at what happened in the 70s and what's happening now, and it was very similar. From 75 to 77, we had recession, CPI fell dramatically, and then in 77, we got the Fed a little bit more accommodative, and even though a lot of the geopolitical situations seemed to rest at that point with war and Middle East and oil embargo and Vietnam War, we still managed to get into this next crazy wave of inflation. And if we follow in path as we did in the 70s, as I like to look at, then it is possible that a second wave is coming, but you've got to look for the signs for it, and there are certain things you can watch. So one, you should watch silver, which is still incredibly cheap, especially relative to gold. Watch oil, and interestingly enough, watch sugar prices, because sugar, which is a worldwide staple, has gone from 5 cents a pound in 2020 to now, it went up to 28 cents in 2023. It's about 22 cents. Hasn't come off that much, but in the late 70s, sugar started to explode even before the gold and silver did. That would be an interesting inflationary sign. So we just wait and see until that one of those things happen.
That's really, really fascinating. You're right, indeed. Sugar is a really interesting market to watch for sure. It is a commodity that no one values more. Arguably, you could argue it's more valuable than gold and silver in some ways. Speaking of a throwback, I like how you did the whole illustration of what happened in the 70s and what happened after that. While we're on the throwback theme, I spoke with some people over the course of the last few days about the AI boom and how they're likening it almost to the dot-com bubble and that it is bound to burst. Do you think that the current AI boom is a little bit different given that it's, I wouldn't say nascent, but it is carrying on in terms of really climbing that wave, but can it sustain the momentum given the economic and inflation risks we're facing at the moment?
Great question. Let's see if I can unpack that question because it's really three parts to that. So number one, in terms of the dot-com bubble and this, the only similarity I would see is that back during the dot-com, any company put dot-com behind their name, and of course it was bought by investors because it was heading into this incredible bubble. Whereas AI, we will have a certain number of companies that are talking about the use of AI that won't necessarily really improve their bottom line to profitability. While the difference between the dot-com bubble and now is that AI, as you mentioned, used the word nascent, is the perfect word to use. And it is growing, and it will continue to grow. So there'll be the normal shakeout of companies that are more hype than substance, just like we saw back then where one of the major winners of the whole dot-com bubble, of course, was Microsoft. Mm-hmm. And here they are now really at the helm with AI.
That's
too.
True.
So so that's where I see the similarities and the differences. As far as can correct and what would make that happen, as I said before, what I really like to say is if we took a snapshot, a still photograph, if you will, of what's happening right now, you would see things looking pretty happy. You would say, wow, everything's working well. The market has accepted the rates, has accepted the fact that inflation is still high, but not as high as it was, has accepted the fact that even though there's turmoil around the world and problems with the Middle East, nothing's really impacting the United States. You know, here we have this crazy election coming up, but yet nothing has really happened in that way. Companies are happy. Bond traders are happy. They're buying junk bonds. Everything looks great right now. So the question is, when is the shoe going to drop? And if the shoe drops, what would it be?
Yeah, exactly.
It would either be, I think escalation of war, oil prices going crazy. These are the kinds of things that would create a liquidity crisis. That's when you might get some kind of a major sell-off. Otherwise, we're seeing kind of a low volume right now in the market at high levels, which means the volatility is so low, nobody's particularly worried at this point.
That's a good point. Just a final question here, Michelle, before we let you go. There's been this idea that stocks have had a life of its own with the correlation between them and the U.S. economy no longer entwined and therefore no longer useful in some ways. Do you think that in the latter half of this year we could see the two reconnecting?
We're starting to see it now, and I love that question too. So one of the things that I have done to wrap my mind around markets and economies and to keep it very simple is I created these characters that represent what I consider to be the most salient aspects of the economy. So it would be small caps, retail, transportation, semiconductors, biotechnology, and banking, right? And Bitcoin is the newest member. And so if you look at what's happening right now, Stanley Druckenmiller years ago called transportation, small caps, and retail the inside sectors of the U.S. economy. Well, transportation just about took out all-time highs. Retail is right now rallying, even today as some of the other areas like tech corrected, retail closed up pretty well, and the small caps closed green. So it is possible that we will start to see that reconnection, and it may already be beginning. Now, this could be just some kind of a catch-up play as money's rotating into undervalued assets, but it could also be real. So that remains to be seen.
Michelle, you have painted such a clear and interesting picture for me here this morning. Thank you so much for your time, and your insights have been really valuable to us here on Asia First. You have a good day ahead, okay?
Thank you so much, Andrew. It's a pleasure to be here.
It is a pleasure as well for us. That is Michelle Schneider. She is the Chief Strategist with MarketGauge.